Ladies and gentlemen, good day and welcome to Garware High-Tech Films Limited Q3 and 9-month FY26 earnings conference call hosted by Go India Advisors LLP. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Garima Singla from Go India Advisors LLP. Thank you, and over to you, ma'am.
Thank you. Good morning, everyone. I am Garima Singla, and it's my pleasure to welcome you on behalf of Garware High-Tech Films Limited. Thank you for joining us today for Q3 and 9 months of financial year 26 earnings conference call. This call is being hosted by Go India Advisors. Please note that today's discussion may include certain forward-looking statements. Therefore, they must be viewed in conjunction with the risks that the company faces. Today on the call, we are joined by Mr. Deepak Joshi, Director Sales and Marketing, and Mr. Abhishek Agarwal, the CFO. I now invite Mr. Deepak Joshi to present the company's business outlook and performance, after which we will open the floors for Q&A. Thank you, and over to you, sir.
Thank you, Garima. Good morning, everyone, and thank you for joining us to discuss the performance of Garware High-Tech Films Limited for the third quarter of FY26. To start with, wishing you and your loved ones a very happy new year. Garware's business model, true to its 90 years of heritage and innovation, integrity, and customer-first approach, remains resilient in the face of uncertain global macro conditions. Geopolitical volatility and successive tariff actions by the U.S. administration continue to pose a challenging environment for the exporters. During the quarter, we experienced the full impact of 50% tariff structure. The offtake was calibrated to maintain undisrupted supply chain. Even in this challenging environment, GHFL largely maintained its offtake. Revenue declined marginally by 1.6% YOY. Even for 9-month FY26, revenue decline was limited to 2.4%. Our order book continues to remain robust. Despite a 50% tariff, the EBITDA decline has been contained at 7.4% on YOY basis in Q3 FY26. For 9-month FY26, the decline is around 8.3%, primarily on account of tariff-related cost absorption. Export continued to form a significant part of our business, contributing 74.3% of total revenues for this quarter. Our Sun Control segment witnessed a strong demand. Our architectural film business continued to expand rapidly in all geographies, including Middle East and Indian markets, backed by focused marketing initiatives and premium product launches. Recognizing the growth potential in the Middle East market, the company has announced to establish a wholly owned subsidiary in UAE. The new entity will manage trading and exports of films, ceramic coatings, and paint protection film across the MENA region and other international markets. We also set up two of its kind global application studio in UAE, and we are in process of onboarding more partners across the globe to strengthen our brand equity. This strategic step meaningfully strengthens Garware High-Tech Films' global footprint, expands export capabilities, and enhances long-term growth visibility in overseas markets. We had successfully doubled our paint protection film capacity to 600 LSF in September 25. The capacity is ramping up as per the plan. The expansion has enhanced manufacturing efficiencies and unlocked additional capacity headroom for our future growth. The upcoming TPU manufacturing line, which will be commissioned by October 2026, will further strengthen our backward integration and innovation capabilities, with 25% of the capacity earmarked for new generation products. In addition, We launched Garware Home Solutions, a new D2C business vertical aimed at expanding our domestic footprint and cater to unmet consumer demand in the architectural film space. We opened our first GHS studio in Chembur in Mumbai. It is in collaboration with a local interior design firm, and we plan to follow the same approach to increase our presence to all towns in India. This platform will help GHFL directly engage with consumers and premium real estate projects while enhancing brand visibility and driving higher margin growth. Our Garware Application Studio network, which acts as a direct-to-consumer channel for premium PPF and glazing films, continues to expand rapidly. We are targeting to cross 300 plus studios by end of FY26 and have already crossed 250 stores in Q3. This will strengthen our presence across Tier 1, Tier 2, and Tier 3 cities in India. Overall, despite external challenges, this quarter reflects GHFL's resilience, adaptability, and strong operational foundation. Our continued investment in capacity expansion, product innovation, and brand building initiatives will ensure we remain well positioned to capture emerging opportunities and deliver sustainable value to stakeholders. Thank you very much. Now I hand over to Mr. Abhishek Agrawal, our CFO, for financial commentary.
Thank you, Deepak, and good morning to everyone. Let me now take you through the key financial highlights for the quarter ended December 31st, 2025. For Q3 FY26, our consolidated revenue stood at 459 crores compared to 466 crores in Q3 of FY25, reflecting an 1.6% year-on-year decline, primarily due to the tariff-related disruptions in the key export market. Despite this, exports remained stable at 74%. EBITDA stood at 86.7 crores compared to 93.7 crores in Q3 of FY25, showing a decline of 7.4% year-on-year. The EBITDA margin stood at 18.9%, down only 118 bps year-on-year, maintaining a healthy level despite tariff headwinds, which has primarily been driven by cost optimization initiatives. PBT came in at 73 crores, down 9.8% year-on-year, while the PAT for the quarter was 55.8 crores compared to 60.8 crores in Q3 of FY25. On 9-month basis, the 9 months of FY26 revenue stood at 1523 crores, marginally lower by 2.4% year-on-year, while EBITDA was at 343 crores, down 8.3% year-on-year, reflecting the cumulative impact of tariff volatility. On the balance sheet front, GHFL continues to remain debt-free with a robust cash and liquid investment balance of 669 crores as on 31st December 2025. This strong liquidity position provides ample headroom for our ongoing strategic capex, including the TPU line, as well as future innovation and expansion initiatives. Despite short-term headwinds, GHFL continues to maintain a strong financial foundation and steady operating cash flow generation. With new capacity additions, continued focus on value-added products, and improved manufacturing efficiency, we expect to gradually enhance our revenue visibility and profitability in the coming years. Thank you all. Over to Garima.
Over to the moderator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Mahesh Bendre from LIC Mutual Fund. Please go ahead.
Hi sir, thank you so much for the opportunity. Sir, despite of soft quarter and the tariff issue, we were able to hold down our gross margins really well.
Sorry to
So,
interrupt, Mahesh. Can you please speak a little louder?
yeah, I'm audible now?
Yeah, please go ahead. Thank you.
Yeah. Sir, my question is, despite of such a soft quarter, still our gross margins were not impacted that way for the quarter. So,
Yeah. Normally, like you said, Q3 for us is a soft one because the seasonality, there is no sun control kind of theory we say. But we have been working on this because after the impact of tariff, which was hit full of 50% in this quarter, we managed our operational efficiencies pretty to the best of our possibilities. I mean, we went with lot of changes in for operational efficiencies. And plus, the product mix which we tried to make, keep it at a very high level. That means the more of a high-end products. So that's how we were able to maintain this.
so the tariff that we are paying now, where it is booked, it is in cost or is it in sales?
It's a mix of both. I mean, we are passing some of it to our distributors, dealers, which ultimately goes to pass on to consumer, but a very small fraction to end consumer. But some of it is passed on to our distributors and customers. The rest, we are observing with our efficiencies, operational efficiencies and product mixes.
No, my question is, sir, suppose we were paying 100 rupees last year, I mean, selling the product. Now, because of the tariff, the price has gone up. So that incremental, incremental amount that we are paying as a tariff, that is gone into what? Where that is booked in sales or it is goes into expenses?
No, that
Mahesh, it has both the impacts. The increased sales price to our dealers and distributors, it reflects into our sales numbers, while the tariff which we are paying, that becomes part of our expenses.
Okay. Okay, sure. And sir, given the current outlook, I mean, do you think, I mean, we are trying to set up a new plant in Middle East. So when that plant will come up and that will have any impact in FY27?
See, we have set up this subsidiary because our growth in Middle East, North Africa region has been phenomenal, I would say. We have doubled in 1 year the sale to Middle East region. So we need a strong subsidiary which can take all the contracts from big companies, local companies, because especially for the architectural business, Middle East is continuously growing, and there is a need to block the sun, the heat in many cases. So the primary objective is to cater to that reason. Then the structure of duties from that subsidiary always becomes makes it more attractive. And third is, with this growth, this is the ideal location for future growth. I mean, we have like multiple objective with this particular subsidiary in UAE.
No, I mean, when this will become functional?
This, there are like many steps to that. The one is like setting up, which will be completed during this quarter, that is quarter 4, right? But the full impact of that might be seen in the later half of FY27.
Okay, and the tax for this will be zero, like nil, right, in Middle East?
Yeah, because this is being set up in free zone. So the tax to earn by that subsidiary is almost nil.
Sure. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Thanks for the opportunity. And sir, congratulations to you and the entire team at Garware, given the environment for the kind of numbers we have been reporting. So just to add to the previous question, yes, the gross margins have remained flat and in fact they have improved year on year as well as quarter on quarter. And you explained that some of it is due to the product mix change. So firstly, sir, this entire 50% tariff impact, has that been visible in this quarter three? And from here on, how do you look at the gross margins going ahead?
See, first of all, yes, we have seen full impact of almost full impact of 50% tariff. But if you really see, again, we are controlling the sales. That means only absolute necessary product are being sold into the market to our distributors and dealers, because in any case of any favorable decision, we tend to gain that. So that's the purpose of that. That's why we said, there is inventory into the bonded warehouses, which can be at a click away whenever the need is there into by our consumers. Now, going forward, full impact is there in Q3. Now, going forward, the margins, because this is, we are seeing, if you see the Q3 margins versus Q3 margins, so there is very less impact. So we think in Q4 and Q1, the margin should remain around 20% or so, depending on the product mix, but we expect to that range. But if any good things from Supreme Court of USA or any trade deal happens, even to 25%, which we are hearing, this is all in public, this thing, that there might be a removal of 25% against Russian oil or something. So that also will give us a big positive boost. And so scenarios are different, but definitely in main season, margins will improve. And if anything goes away like 25% or so, we'll definitely go between 20 to 25%.
Fair enough. And sir, with regards to the inventory at the customer level, the end customer level,
yeah,
how is that situation currently? I understand from all the channel checks in other industries that is probably at the lowest end. So given the tariffs, two scenarios, or let us put the tariff remains at the current level. So how do you look at the inventory at the customer's level and thereby the sales growth going ahead for us?
See, if this remains there, the margin, the sales volume is definitely bound to increase, because still we have got very good numbers and we are keeping the inventory in the bonded warehouse. But now the season is coming. If you really see this quarter, it starts from the March onwards. March sale reflects the seasonality. So sale will definitely increase, right? That goes without saying, because we are not losing any sales. We have protected our consumers from any, I would say, substantial increase in the prices. So that was our end goal. If you remember our last Concalls, we have always maintained that we will not lose any consumer. We will continuously to grow. So ultimately, you are right that there has been a decrease in inventory into the chain from our side, between the consumer side. There has been a decrease, because we try to, we are expecting any good thing. Any trade deal or something will save us a good amount of money, right? So that's why we are trying to keep it at the lower level. But if it does not happen, any deal does not happen, no decision comes into favor, still the sales growth will continue.
So that means this year we can be around 2100 plus kind of turnover as what we have been targeting. And next year, can we look at 15-20% growth over and about 2100 at current tariff of 50%?
See, again, for that, this is a subjective question that, we remain at 50% tariff and what happens, because we definitely expect something better or some action from our end. But definitely these numbers, what we are seeing is almost, sales is stable despite all those challenges in 9 months, right? So we will be close to that number. In fact, this quarter can be stronger, and it all depends on like how I mean, if we feel nothing is going to happen, we can release the goods and from US bonded warehouse, which will reflect in our sales. So we can reach to the numbers what we did last year, because we are already at the same number in 9 months. And for
last question.
When it goes,
Sure.
yes, given the scenario that nothing happens, but if you talk of the sales, definitely it will have a 15 to 20% CAGR growth next year. Because this year we have tried to curtail everything, but we'll find other ways. We have found, or we are finding other ways to continue this growth, right?
Sure, that's nice to hear, sir. And last question from my side. With regards to the new PPF unit which has come in, so what is the current utilization and what kind of ramp up we see going ahead in next 2-3 quarters, 2 to 4 quarters?
Yeah. So, PPF also, like right now, it is running around 65% utilization rate. And going
Sorry, sir, there's new line. I'm talking only about the new line.
New line I'm talking, 60, it is
Achha,
running at
okay.
55% capacity. Old line is running full. But the thing is, that is again, if you really see, we are growing very strong in certain regions, that is Middle East, North Africa, India. And there is definitely PPF being a high value. If you really see, the absolute price of PPF versus absolute price of Sun Control, PPF is at a much higher prices, right? Absolute pricing. So the duty impact, tariff impact is pretty high. So we are seeing some challenges from the US market. Despite that, this capacity is currently 65% utilized.
Sure. Thank you so much, sir, and all the best. Thanks.
Thank you.
Thank you. The next question is from the line of Viraj Parekh from Carnelian Asset Management. Please go ahead.
Thank you for the opportunity. Am I audible, sir?
Yes.
Yeah. So the first question is probably if you could give me some insight on this quarter's growth in terms of US and non-US, and also 9 monthly for US and non-US growth.
Yeah. So US is like, I mean, same quarter if you see last year, there was almost 40%, 44% was sale was to US. This, this year, Q3 FY26, it is around 40%. So there is a marginal 3% drop, but that all has already been, more than that is already there in the warehouses to be sold, against orders. So real sale, we'll see a 3% degrowth in this market, in US market, but in absolute terms, it has grown because we have dispatched the material against orders, but not yet. It is in the bonded warehouse and waiting to be invoiced. So that's why we have maintained, like I've been saying, we have controlled the sales to avoid any impact. So 43 and 40%. Then if you talk of other geography, like Middle East was used to be around 4% last year. It has crossed 8% already in 9 months, right? And EU has been stable around 10 to 11%, and India around 25%.
So you said Middle East, EU, and India numbers are for 9 months, right?
Yeah. Now,
so what would be the 9 months?
3 months. You asked for the last quarter, so I'm giving you last quarter number.
Right. And so what would be the 9-month number, if it's handy with you?
So just a second. Yeah, numbers are similar because we have started seeing this kind of trend since, if you remember, the March, this tariff thing started. So almost the same numbers.
Got it, sir. Just to follow up on the previous...
you can ask offline, but the numbers are similar. So I gave you absolute exact numbers of Q3 versus last year.
Sure, sir. I'll take it offline. Just a strategic understanding, if I wanted to understand on the previous participant's question, he was asking in terms of the inventory at the channel level in different geographies. Mm-hmm. Since Q3 was the first quarter with 50% tariffs, at strategic level, how are we looking at production in a normal versus a tariff environment? at what kind of inventory levels are we maintaining in a normal versus tariff environment? So just wanted to understand that, what is the range between the two? How have we pivoted to navigate the tariffs? Because, we've been doing an exceptional job with our margins.
Yeah. So, if had there been no tariff, so our inventory levels remain roughly 1 month in US and around 1 month in transit. So it's like a 60 days inventory, you can say, at our warehouses plus in transit from India, right? So this ranges between I can say 60 to 75 days. Right now, if you add everything, so this goes almost, I can say, more around 100 days. I mean, it's like you can just see 60 days versus 100 days. So there is like 30, 40 days more inventory is lying with us in the warehouse. I mean, transit remains the same, only in the warehouse inventory has been increased. And that has been done purposefully.
Got it, sir. And how are we looking at the production levels, I mean, capacity utilization across our lines in a tariff and a non-tariff environment?
Yeah. So now in case of current situation, so India, I mean, the manufacturing and everything lines are running full and having like we are not changing anything at the level of production because orders flow is good and lines are being utilized at optimum level. However, we only control at the customer at a warehouse level in USA. As I told you, the aim was not to lose any customers. So all the orders are there. Only release of the material just to see any kind of gain in 30, 40 days will fetch us additional revenues. So that's why we are keeping it like that. So 30, 40 days more inventory at the warehouse level. However, factory is continuously producing as per the requirement because we only produce against the orders and we have enough orders for this quarter and going forward.
So just a follow-up on that, currently growth is a little bit muted, because of the tariff situation. If we are maintaining our lines at full, for the, you can say last 1.5 quarters, there would be some time where, production would kind of reduce if the tariffs don't go away anytime soon over the next 2 quarters. So that time, would we have to revise our strategy or we continue in the same thing because your anticipated demand growth is strong? So despite 100 inventory levels, you're seeing growth at, 15-20% for stronger Q4 and Q1.
Yeah. So, like I said, there are some other alternative ways are being worked where, if we can mitigate the impact of this tariff. But at the same time, even if it continues, we are maintaining the margin like this quarter, if you see being the seasonally low quarter, we have almost touched, I can say, close to 20%, right? So, given a situation like this remains and nothing else happens, of course, there will be many factors will change, geopolitical situation, tariff situation, and our situation to cater the market. So, there will be all 3 places, there will be definitely some changes, right? But let us assume nothing happens, like nothing changes. Still, we will maintain a growth of 15-20% because we will not hold inventory in our warehouses. We will do whatever sales naturally happening, which is at the rate of 15-20% CAGR, right? So why do we curtail then our productivity? We'll continuously grow because we are still making margins on that.
Right. So this last question, I get back in queue. So for Q3, I think the CFO sir said that, our margins in the range of 18%. If I just remove the other income portion and just look at, EBITDA without excluding other income,
Yeah.
it's in the range of 15%. Just wanted to know that, in our think tank on the drawing board, when we look at all the possible scenarios in terms of downside, do you see that if a challenging environment persists going ahead, the margins can see further decline because of stressful demand environment in especially US?
No, because as I'm saying, the scenario for Q3 is always different because it's a seasonally low. Every year Q3 is like that. So if we see Q1 and Q2 are a strong seasonal season for us, so the margin will definitely improve. That directly linked to more IR production or high margin products in in Q4 and Q1, right? So, the margin maintenance definitely will improve. Now, the question of your question was, yes, if this situation remains, we continue to produce. However, there are some strategies which are being worked out or to mitigate the impact to some extent. So that definitely will come. We are not, we all the time working on this situation, like how do we navigate through this situation. Though every one of us, including our exporters, thought it's a short-term phenomena, but we are prepared for a long-term as well, like that remains, that becomes stable at 50%. That too will maintain 20 plus margin and with the sales growth of 15% bare minimum at CAGR level.
Thank you so much, sir. All the very best. I'll get back in queue.
Thank you.
Thank you. The next question is from the line of Jay from Phillip Capital. Please go ahead.
Hi. So just two quick questions. One is on the product mix compared to Q2 with respect to your window films, PPF, and IPD. Has that stayed stable or is there any change in that mix? And the second one is with respect to architectural films. How has the growth been in that area, and what sort of revenue can we expect over the next couple of years?
Yeah. So, in the question of product mix, right? So, what happens is, in Q3, this normally the lower range of window films sell more, right? So, when it goes towards high season, more IR product demands comes, which is a near infrared blockage of the films. So they tend to have very special films with our nano particles into that. So that generally carries a high margin as compared to the mix. So that's why we are talking of product mix in Q3 versus Q2 and of course in Q4 as well. So Q4 goes better in terms of product mix, right? So that is a general phenomena with us with under certain variables, right? It goes up to extreme in Q1 and slightly lower in Q2, extremely low in Q3, then again goes back in Q4. So this is the phenomena which we always track, and we are well under control for that particular thing in going ahead, right? So that's what was the second question, sir?
So with your architectural films, I just want to understand how has the growth been in that segment, and is there any ballpark revenue which we can expect in that segment over the next 2 or 3 years?
Yeah. So if you see, we started this architectural journey at around 10% of our total CPD sale, right? Which was roughly 15 crore last year, 1,500 crore last year, right? So now currently we are at around 20 to 23% of architectural sales, but with ultimate aim is to reach around 30% of that. From current level of 300 crore plus, we will reach in by next financial year to around 400 and then 500 crore out of it.
Okay, so got it. Thank you. I'll just jump back in queue if I have any further questions. Thank you.
Thank you. The next question is from the line of Vinay Nadkarni from Hathway Investment Private Limited. Please go ahead.
Yeah, thanks for the opportunity. Just a couple of questions on the UAE plant. You said that it will be commissioned in Q4 26, is it? Am I right?
Yeah, that's the subsidiary, yes.
No, the manufacturing plant will be commissioned in Q4?
We have not announced any plant in UAE, right, to be very precise. There are some plans which we are working, but this is as of now it's only a subsidiary which will cater the business to MENA region and other exported to other regions.
So it will be a trading subsidiary primarily.
Yes, as of now, to start with, it will be a trading subsidiary.
Okay. Secondly, on your gas studios, now that you have more than 250, are they operationally profitable?
Yes.
So they contribute to the bottom line.
Profitable, but they are not standalone ones. They are the ones which are with other product lines like auto accessories and all.
But they are profitable. I mean, because in retail generally.
Product it is.
Okay. And as far as your US tariff impact is concerned, in this quarter, did you see any prices getting dropped because you were absorbing the cost, or how was it? Or did you maintain the price and absorb the cost?
See, we are like the tariff impact, like I said, is 50% additional. In that case, in the 50%, we absorb most part of it, but there is some portion which is being passed on to our customers, right? So we cannot specify the number because that a lot of questions come to us like on the parity and all those things on the competition advantage.
Understood.
Right?
Yeah.
So one portion is passed on, another portion is absorbed on, but we have mitigated that successfully. Again, if we see the numbers of Q3, like our on the sales of that particular amount which we sold to USA, which is 40% of total sale, right? Out of that, if we add roughly 40% of the tariff and minus whatever has been passed on, so there has to be a 50 crore impact on PBT, right? Which we did not see. We saw only 7 to 8 crore impact. So we have successfully navigated by our efficient manufacturing process and efficient, product mix strategy. And some of the products which we diverted to the territory where it was going to USA, then being diverted to other territories, we have really managed that well by sending it to like re-exported cargo kind of thing. So a lot of strategies has made us to navigate the impact of roughly 40 crore for the quarter. So that's how it has gone to like a PBT level of 73, 74 crore. So that's how we managed it. Yeah.
So basically, what you're saying is there was a 50 crore downside, but you managed 40 crores from other areas to make it.
There was a possible. If we really
Yeah.
duty and everything, of course we pay the duty. But I'm saying if you see plain and simple, you have a product sale and you have this additional duty, you would have that kind of impact. But we successfully navigated through by passing on to something and then efficiency improvement, product mix change and all those, and selling to the territories where earlier it was going through USA, now directly going. All those strategies we have worked out to mitigate that impact.
Okay, just one last question. Given the fact that this uncertainty in US is going to continue for the next 2-3 years till the time this present government is there, what are your plans to expand in other areas? Have you accelerated those, and which are the areas that you're looking at in expansion?
So first and foremost, we have grown really well in Middle East region. So we have, the sale which was last year versus this year has doubled. If we see last 3 years, 2 years, where a tariff was not seen, but if we compare versus 2 years to now, the growth has been almost 3 to 4 times, right, in terms of sales from that particular region, from Middle East, North Africa region. So that is continuously growing. And we are also growing in the markets like China. There are a lot of plans where there is we are doing partnership with some top players to gain advantage of that market because our product is really good. Only thing is we have to our brand global really does well there. So that area we expect to grow really well. And even in US, like I said, in terms of orders and everything, we are continuously growing. We are taking share from top of the peers. So that growth is also there. So any moment, any positive thing from USA, even if it is 25%, will really, be a great thing for us. But even if we assume that 50% is going to remain there, we are confident that we will navigate through really well in Q4 and then next year onwards, because we have strategies in place which will be announced shortly.
Okay. And lastly, does this impact your white labeling business, or is it impacting your brand business, this year's tariff?
See, it impacts both because the tariff is applicable for both. But if you really see on white labeling, there are possibilities because white label people sell all around the world as well. So we are directly selling them from India. So in that case, we are able to distribute this thing really well. Without it does not go to US.
Yeah, I understand. Territory. Yeah. Thanks a lot. Thank you for your answer.
Thank you.
Thank you. The next question is from the line of Priyank Agarwal from Equirus Securities. Please go ahead.
Hi, sir. Thank you for the opportunity.
Thank you.
Am I audible?
Yes.
Yeah, so my question is that in CC we have seen revenue being stable despite that the margins have declined. So how the margin was impacted, like because of the temporary investment in D2C during subsidiary branding, or like or it was because of the structural cost pressures? And in the coming quarters, so how do you see the EBITDA margins going forward?
Yeah. So, EBITDA margin, the primary reason is, of course, tariff situation in US, which was 50% additional. So like I explained, had that not been there, we would have really done well. But we have to accept the fact, whatever it is, right? So that's number one. Number two, in Q3, our margins are usually in this range only, like 18.59%, 19%. But when the seasonal mix changes, it will improve. It will go 20 plus easily, even with 50% tariff, right? That is number two. Number three, we are doing a lot of activities like we have opened like direct to customers global application studios in Middle East. 2 of them has been opened in last week, and there are more in pipeline. So that will really boost our brand image and direct to consumer business where margins are good with the brand visibility. Then we are doing Garware home solutions in India. We just launched one in Mumbai, but there will be many more to come. So that will again create a demand in India market. Then Garware application studios, which are 250 right now and will reach to 300. So this is again direct to sale. And in US market also, we are signing up a lot of such studios, which we are in the process of doing so. So that will also boost our sales and profitability in US market when we go directly to consumer, right? So all those things we are actually, if you really see, the company's focus is to become more of a consumer driven. If you see each and every steps of ours, which is Garware Application Studio, Global Application Studio, Garware Home Solution, Global Home Solutions, this will really, we are trying to become more as a consumer brand than as a, B2B kind of business.
Thank you. And my one more question I have regarding this Garware Home Solutions.
Yeah.
What is the revenue model here? I mean, in terms of franchisee versus company owned, and what kind of capex we are looking at this, and the OPEX, if you want to scale the D2C over the next 2 to 3 years.
Yeah. So see, I can give you some highlights of that. The Garware Home Solution means the model is this is like a channel which is e-commerce based model, right? So there consumers will directly pay to the company, and the company will have those franchisee models or those, I would say, outlets where they do the work, applications and others, and they will be paid accordingly, right? So it is full under Garware company's control, right? Right from their database till payment and everything. But it is more of a, like I said, it's a e-commerce based model, because physically this model cannot work because the ticket size are very small, but the number of consumers are enormous, right? So that's the primary model, and these platforms and everything have been created, but still into the testing models or testing modes. Now, on CapEx, there is hardly any CapEx into that, because company already does these kind of products. The main products are sun control film, surface protection film for your furniture, for your kitchen sink, and etc. There will be more products like switchable films. There are some coatings which are required for the home. So most of the products company already makes, but it needs a different kind of attention, which we are doing. It's mainly a selling platform, selling and a branding platform for the company. Hello.
Yes,
Mr.
sir.
Agrawal,
Thank
you
you.
have
That's
more
all from my
questions?
side. Thank you. That's all from my side.
Okay, thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. The next question is from the line of Swechha Jain from ANS Wealth. Please go ahead.
Hi, sir. Thanks for giving this opportunity. Sir, I have a couple of follow-ups actually, because most of my questions have been answered.
Yeah.
So my first question is regarding the Dubai subsidiary. I believe you said that right now what we are looking at is mainly from a trading point of view to cater to those geographies. But I also heard you saying that, we might set up a manufacturing kind of a unit somewhere, down the line. So if we ever decide to set up a manufacturing plant outside India, I wanted to understand, would it be in this subsidiary or any other geography that we are looking at, sir?
See, first of all, the basic thing is, if you really see versus our the tax proposition and the growth into that region, so the growth has been really great. So that's why it makes a very obvious choice for us to open a subsidiary, because we have tripled our numbers in 3 years, and much more to come, because we are signing good agreements with top companies in real estate and architectural space. So the business is growing. Then it is ideal for the duty structure in the free zone, right? And that's one. And third is, there are opportunities to export from these regions at a good these things. So these setups are being made. The details we are the subsidiary opening is pretty fast, and this will happen in next 1 or 2 months. But there are other actions onto that, the manufacturing means what kind of manufacturing. There are a couple of options there, which has been evaluated and being worked out, right? So there is no timeline and there is no commitment from us as of now, but definitely it is making we are making the decision in a way to take maximum advantage of that region plus other geographies in terms of taxation and other purposes. And growth is the forefront of everything. The company growth numbers in that region. Yeah.
But would it also mean that once we start manufacturing here, we can also sell it to US, and then would it also help us from a tariff point of view, is what I wanted to understand basically.
See, I will answer in this way. Middle East is very near to us, right? So setting up a facility to sell in Middle East is maybe one of the reasons. But, the main thing is not looking into the geopolitics and everything. That's like we are in India, and one thing in Middle East always makes good sense for us to reduce the geopolitical, impact, or to reduce that impact to us. So that's very important. So that's why we are working on this. But as of now, I can't say this much only. We will, whatever is there, we will announce properly and let you know. As of now, we are opening a subsidiary. That's very open, and we are exploring all opportunities. We are not, like we said, we have maintained 18 to 19% EBITDA margin, which will go to 20 plus. But of course, we want to go back to the numbers where we were, like 25 plus minus 2%. So ultimate goal is that. So we have to reach there, and we will do that.
Right. Right. So in this EBITDA margin, the 20 plus that you are saying, this includes the other income, right? This margin that you guide is considering the other income, right? Is what I want to understand.
Yes.
Okay. Understood. And so my...
Sorry to interrupt, Swacha. Sorry to interrupt. Please rejoin the queue for more questions.
This is my second question, sorry.
Okay, go ahead.
You got along two questions, right?
Go ahead, please.
Yeah. So my second question was, so just want to understand on the architectural side, how much we are planning to invest, in this business in terms of people, in terms of the marketing. If you could just broadly help us understand our overall strategy for this business in the medium term, and also in the long term, like what geographies and what products.
Yeah.
And what kind of revenue potential this business can have for us over 3-4 years, and margin guidance for this business specifically, and what kind of ROE can we get from this business?
There are 7-8 questions for me. Okay. Yeah.
So they only give us 2 questions to ask, so what to do?
No problem. I'm happy to answer. So let me tell you the journey. Like we said, we started 2 years back when the total business was around 10% of total consumer product sale in architectural business, right? And right now we are at the level of around 22 to 23%, right? So how we have grown and what are the strategies to grow faster is this, and architectural products are little different in nature as compared to automotive. Garware is very strong in automotive business, but with slight change investment which we have already done in last 2 years in new lamination line is helping us to grow in this business. So there were, architectural business needs many kind of products. That includes your sun control, which reduces the heat and controls the glare, reduces the ultraviolet rays, UV rays to avoid the cancer. And then there are safety security films. That means whenever you are seeing the school, colleges, banks, which are high-rise, especially in the markets like USA, so there they need a very high protection from this. So these are safety films. This may be transparent in nature, colored in nature, but nobody should fall from that height, or no, even in some cases from the distance range, nobody should get hurt if there is a shooting on such incidents like in USA, right? So these, and one more thing is there are certain products which are decorative in nature, like interior decoration and all those things. So now, so these kind of product range, like 3-4 years we were missing, but last year everything has been completed. We have a complete range of products, right? If you ask any of out of these products, they are available and manufactured by us. Because of this, we have been able to attract good distributors in USA, Middle East, and other regions. We were from the who were doing the business with the top of like our peers, right? So we have attracted them because of our entire product list. Then our pricing, because we make end-to-end products by ourselves, that means all we are fully backward integrated for all those products. So we have like a competitive advantage in terms. We are not far off. I'm talking of only 10 to 15% as the prices. So we have like a full range of product and at a best I would say pricing. Best distributors in Middle East, USA, and India from our peers, they have moved to us. And the last and not the least is the team which was like earlier there used to be only one team. Now we have like a separate architectural teams all around the world. That includes in USA, we have a top person from a peer group. He has really done well and got some big distributors converted to our brand. Same in Middle East, we are growing, and one of the major growth area is architectural there. And in India, we have done almost all top hospitality hotels in India and all airports, railways, and everything. We are working under this segment. And one of the most important thing, like I said, there is people, good resources from our competition. Then we have all product lines, we have good pricing, so this is really working really well for us. If we see the revenue size, if we go up whenever we are targeting now around 500 crores by FY27, and I can say like similarly if we talk of by FY30, we have an ambition to make it to around 1000 crore with Garware Home Solution in it.
Okay. Thank you. Thank you, sir. This really helps a lot. Really appreciate this, sir.
Yeah.
Thank you. The next question is from the line of Suruchi Jain from Opportune Wealth Advisory. Please go ahead.
Hello, am I audible?
Yes, you are.
Yes, thank you so much, for taking my question. I want to know more capital and other.
Sorry to interrupt, Suruchi. We are unable to hear you. Your voice is breaking, ma'am.
Am I audible now?
Yeah, please go ahead.
Yes. In view of the pricing difficulties, I wanted to know how this has impacted your, working capital cycle. Say, have the receivables, gone up, or have your payables been a problem? Any cash flow constraints or, cash cycles extensions? What are you also seeing on the competitive side? While you are finding solutions at your end, what are competitors doing? As I understand, your product is of high quality and, high price as well. It's a premium product. But there are always competitors looking to undercut and take away share, when things like this happen. So if you could share a little bit on both these aspects, please. Thank you.
I'll explain you on the aspect of quality and what our competitors are doing. Right. The other part we'll try to answer, but the question was not clear. So let me answer you first the competitive landscape. So, the product which we make, it is made out of very high base films, which is normally available with only few people in the world. And the reason of that is we are fully backward integrated. That means we make our own base film. We do like metallizing, we do the nano dispersion facility and some preparation on the base films, adhesives, and our top coats like surface resistant coating and everything into window films, right? All those processes have been developed in-house, and this has been a work of last 30 years, which is working very well for us. And the machines and everything has been designed by our engineers with the help of experts from big companies who give us the machinery, but not a single machinery manufacturer is there. There are many involved in that. So there is a big entry barrier if somebody tries to copy, right? And there are many of them, more than 10 patents are there, which are like very essential part of our manufacturing, right? So this is what we are. Now, and that's how like many companies around the world who want to partner with us to have our basic films. But we have chosen the path to growth by ourselves, right? So, and if you see the journey in last 4-5 years, we have shown the kind of growth we can do with our products, right? So if we really see the product comparison, if we do, it's only with some of the US manufacturers, right? And we have partnership with many of such manufacturers as a white box in USA, right? So there are very limited people who make similar films like us, but Fortunately for us, unfortunately for that, the growth in U.S. market for manufacturing is really challenging. They are not able to grow that fast in that market. In terms of manufacturing capability, so there we are coming into picture, and we have a lot more opportunities where we are filling the gap by supplying to them, or looking for opportunities where we can do some kind of partnership with them into these advanced markets.
Okay, got it. So my first question was about how the pricing and the environment on the buyer side has changed sort of your, selling power, if you say. Pricing power we know about, but say, credit cycles, have they got extended at any part of your working capital is under pressure? Anything, if you could share internally how this has impacted you and your negotiations, so to say, with existing or old clients, new clients, sorry.
Yeah. So actually, nothing has changed, let me tell you, because of this situation. Because like we said, we have managed this situation by our operational efficiencies, all right? That is a product mix, making the product with higher efficiencies and everything. And plus only a limited tariff impact has been passed on to our customers, right? Rest we have absorbed by the ways which I just told you. So no change in terms of credit or these things have changed. We are like the cash flow is really strong, and we don't have any such challenge with us. No change has, we did not witness any degrowth. Whatever we are seeing here is already we have orders, but we are keeping the material so that whenever it is like just in time kind of model we are working now in US. So no sale drop has happened. No customer has been lost, right? Only the slight impact which we are seeing on our margins, which is quite well and open. But the growth is there and will remain there. So no change in that.
Okay, and just one small question.
Sorry to interrupt, Suruchi. Please rejoin the queue for more questions.
I'll do that.
Yeah,
Thank you so much.
Thank you. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Thanks for the opportunity. Sir, firstly, if you can, we had a sales of around 325 crores for CPD for our consumer division. If you can give us the breakup of Sun Control films and PPF in that for Q3 as well as 9 months.
Yeah. So Q3, 40% of Sun Control, right?
Okay.
No, it's 44% Sun Control, 26% PPF, and 30% of IPD.
Okay. Sir, the other question I wanted to ask was, when you say 65% capacity utilization of the new PPF line also, this is primarily because our PPF sales have largely remained flat on a 9-month basis. And so we would have, the SCF facility that we were utilizing for manufacturing the PPF, that would have now moved to the new PPF line, and we would have, more spare capacity on the SCF side. So is that the right understanding?
Yes. Whatever we were running like 130, 140% in old line with the help of Sun Control line. So you are bang on that. Now we have moved all the product to PPF line, and all the Sun Control is there. So both lines are growing on their own. Both plants. There are 5 odd plants in Sun Control line and 2 plants in PPF. Both are running on their own. That's why we are seeing this growth as a minimal growth, or I would say. But as I said, one of the real reason is the US market. The PPF prices, absolute prices are very high. So impact of tariff on PPF seems to be pretty high as compared to Sun Control, because absolute prices of Sun Control are lower as compared to PPF, right? So that's why, so PPF challenges are more, but despite that, our growth in markets like India, Middle East, Europe, and other markets has been really, really good. South America for PPF, which has taken the burden, offset the difficulties of the US market.
So when we are looking for...
Sorry to interrupt, Ankit. Please rejoin the queue for more
This is
questions.
the part of the second question only. So when we look for expansion, sir, now will we be expanding on the PPF side or SCF side?
See, if you
For
really
next phase
see,
of expansion.
we will expand on the first on TPU side. So one TPU plant is coming, which is barely for one PPF line. So we will be doing another, not yet announced, but we will be working once that is successfully done, the TPU line. So we can do more of those lines. But definitely, having said that, the kind of growth we are seeing despite the tariff. So if any situation comes, I think the next one in line maybe Sun Control. But this all, as of now, we have not decided. But since you asked what looks more plausible for us, so it looks plausible for us TPU and then Sun Control. And then after that PPF. But we are on a good growth trajectory despite the tariff situation.
Okay. Thank you, sir. Wish you all the best.
Thank you.
Thank you. The next question is from the line of Dhanil Desai from Turtle Capital. Please go ahead.
Hi, good afternoon, Deepak and team, and congratulations for a very good set of numbers in this environment. So Deepak, the first question is on the TPU side. I think we have reserved the 25% capacity for the new product. So I'm sure that, now because next year it will get commercialized the TPU line. If you can...
We are commissioning.
Take care of, yeah. So given that, if you can talk about the kind of product slate that you have, and we have a history of creating large products of the tune of 500 odd crores, like we created PPF, then now we are creating architectural films. So do we see a product basket where one or two products can really scale to those kind of numbers in terms of potential, in terms of positioning? If you can elaborate on that, maybe without taking names or applications.
Yeah. So, just we have updated in the call that October 26, this calendar year, we are starting this plant, and we have kept around 25% allocated for the new products. That has been done strategically to make products for some architectural applications, some of the medical applications. The R&D is going on. But the idea is to make, because we just don't want to be a backward integration to PPF. Of course, PPF business is going to grow like anything with this, because, we are expecting by next year with these favorable trade deals with EU and other markets where the luxury car segment might see a good boost in sales, which will directly impact the numbers of PPF. That means PPF definitely will grow, because PPF sale happens more towards cars which are, luxury segment, I would say, right? So that will be a very positive impact, and at the same time, TPU will help us to make the right product without depending on external quality factors, right? So we can do lot of products, lot of innovative products for existing PPF line. That is one way to look at it, with margin improvements. Okay, so that is one way. Second is 25% for making new products and doing R&D for those products, especially in the architectural, building and medical segment. And third, once we are I think in 3 to 6 months, when all operations are streamlined and we are onto that path, we'll look for the growth into that area. Yes, to answer your question once again, we are aiming at the similar size of this new vertical from TP.
Got it. And I think if
Sorry to interrupt, Dhwani. Sorry to interrupt.
That was my only one single question, right? It was only one question.
Yeah, please go ahead quickly.
Yeah. So second question, I think you talked about India being at 25% of the overall revenue. So if you can give some color in terms of the architecture, PPF and the IPD, and that's now a substantial number. So how do we see that growing into next couple of years from here?
Yeah. So let me give you the number. PPF is roughly, I can say, close to 20% in India market for all PPF. I'm talking of PPF in the PPF segment, right? So because this number looks bigger because IPD sale is mostly into India, right? The rest, so that's why you always see numbers 20% to 25% in India market. But if I talk of PPF, we have never discussed that, but around close to 20% PPF sale happens in India. And as you know, we have created this market. There was hardly any market before we entered into PPF India business. And we still see with the current rate, it is estimated around 1.5% of total car sales are being protected with PPF. As compared to our around 13 to 15% of the advanced market. So we still see a big headroom in PPF going forward. And with anti-dumping investigations already reaching towards its a final thing. So we expect that will help us to grow our market and margins both in India, right? And TPU will add a further thing to that. And these FTAs are going to add higher end cars, which will definitely. So we are on a long term. We are a player which think what is going to happen in 3 years into PPF industry with the help of backward integration, these FTAs, how do they play out and how do we stop. We are never averse of the competition, but we are always mindful of the people who are supplying quality products to the market. They should not be, I would say, misled by the product which is not in quality, but they just play on the prices. So all those things will be taken care by this ADD. So there are certain strategies which we are working to have that. Main top points I have shared with you in PPF. Now, if we go to Sun Control, our major focus area here is architectural. Of course, automotive with given guidance by the government, we are doing really good. But on architectural segment, all the top, I would say, this hospitality industry, then consumers, then jewelry and gems, and big malls, all are being protected by our Sun Control. We are now certified or approved in railways, in Airport Authority of India, in most of these names which I won't be able to take here, all the hospitality industry. Because what we have done is we are certified, we are the only company in India to be certified by Green Pro, which is government has given that guideline that if you have any building as per the government guidelines, so it is recommended to have a company associated with a Green Pro certification. So we are the only one in India. Then we are GRIHA certified. We are certified by American Cancer Foundation to avoid cancer. And we have certified all our safety fins by UK standards, TUV standards, and EN standards of America. So you see the lot of work, background work goes into architectural certification, product. I explained everything into my previous answer, like how did we grow into architectural business by creating a full range of products, creating full team, making awareness into the market. So all those things will take us this architectural business to next level in India and elsewhere. Right. And when we talk of 25%, like you said, it is mostly major portion comes from IPD, but our growth engine, IPD, we strategically keep it as a stable level, but the real growth will come from architectural, PPF and Sun Control business. And of course, we are working with some companies to supply as an industrial product. So that will also add to this.
Okay. Thank you. Thank you, and all the best.
Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we'll take the last question from Akhil Parekh from B&K Securities. Please go ahead.
Yeah, thanks for the opportunity. And most of the questions have been answered, and congratulations on the resilient performance. Just wanted to understand the impact of depreciating rupee on our business. What percentage of our sales is dollar denominated and what percentage of raw materials are dollar denominated?
Yeah, I'll give you a ballpark number. I think we can answer that offline. But definitely, when the dollar depreciation helps us to some extent, because our lot of key raw materials are based on import parity prices. So if the if the rupee depreciates, so we have that negative impact. But our sale definitely mostly into US dollar or even euro and pound, all those things are appreciating and rupee is depreciating. So this leads to a positive impact for us. But there is like 40% of that is taken away with our raw materials. So that is the net impact on that.
Sorry, 40% is dollar-denominated raw material.
Raw material, yes.
Or okay.
Yeah.
Okay. All right. That's all from my side. Thanks so much.
Thank you. Now I would like to hand the conference over to the management for closing comments.
Yeah. On behalf of Garware High-Tech Films Management, I would like to thank all of you for joining us, taking your time to understand, hear out from us. We will do our best to meet your expectations. Thank you very much.
Thank you very much. On behalf of Go India Advisors LLP, that concludes this conference. Thank you all for joining us today, and you may now disconnect your lines.